Here we're going to be looking at admission of a new partner into a partnership here. And our example is going to be for an asset write-down where the partnership's fair value is less than the book value here of the partnership. And the method we're going to use is the Goodwill Method. And when using the Goodwill Method, the total capital of the new partnership must approximate the fair value of the new partnership here. So looking at our example here, we have an existing partnership between partner A and partner B. They have a total capital balance here of $150,000 and their profit and loss ratio here is 50-50. Each gets 50% here, partner A and partner B. Now we have this partner C, which is going to invest $20,000 and they're going to receive here a capital interest of 20% and an interest in profits and losses here of 20%. So the partner C is going to get a capital interest here of 20%, and then their profit or loss ratio is going to be, they're going to get a 20% interest in that. So let's go down and look at our example here. The book value of the original partners here is $150,000, and then the new partner here makes an investment of $20,000. So the total capital investment here was going to be for $170,000 for the new partnership here. And what we're going to look at here is we're going to calculate the total implied fair value of the partnership to be $100,000, and then we have a difference here we have to account for. This total capital amount here of $170,000 and then total implied fair value here of $100,000. So when using this Goodwill Method here, the total capital amount here has to approximate the total implied fair value. So if the total implied fair value is $100,000 here, we've got to reduce this total capital amount here down by $70,000 here. So let's first look at how we calculated the total implied fair value. Now partner C invested $20,000 for a 20% interest. So doing our arithmetic here, $20,000 divided by 20% gives us $100,000 for the fair value of this partnership here. So the $70,000 here, that could be one of two things here. It could be unrecorded asset write down, or it could be goodwill contributed by the new partner here. But we're going to be looking at an unrecorded asset write down here where the assets are actually overvalued and they have to be reduced. So looking at our total implied fair value here of $100,000 and subtracting here the total capital of $170,000 gives us this $70,000 that we have to write down here for this example that we're going through here. So then again, before in determining whether it was goodwill here or an asset write-down, what you first have to do is you have to go in and examine your asset valuation. And in this case, it was determined that the assets were overvalued by $70,000. So the existing assets should be written down or reduced in this case, and that would be allocated to the previous partners A and B here based on their capital balances. Now their capital balances would be reduced by their old profit and loss ratio, or the profit and loss ratio before the new partner was admitted into the partnership. So let's go and look at our example here. This asset write-down here, it was determined that after examining our assets here, the land had actually appreciated here by $40,000, but then we determined that our inventory was overvalued by $110,000. So we would sum these amounts here and we determine our net write-down here to be $70,000. So just looking at how we'd record this asset write-down here, that capital A here, our partner A's capital amount would be reduced by $35,000 here. Capital B's capital amount here would be reduced by $35,000. They would be debited in this case here. And then the land would be debited or increased for $40,000. And then our inventory account, that would be credited or reduced here by $110,000. So this is our net write-down and how we'd handle that here. Now, how do we determine the $35,000 reduction here due to the write-down to capital A and or partner A and partner B here? Now that was allocated per the previous partner's old profit and loss ratios. In this case, it was 50-50 or 50% to A and 50% to B. So we determined that our total asset write-down was to be $70,000. 50% times that gives us $35,000, and that would be the same here for A and B since their profit loss ratios would be equal at 50% here. So partner A had a reduction in capital of 35% in capital, or 35,000, and capital B had a reduction here in 35,000. So next we'll go and look at the capital accounts and how they're adjusted here after the new partner is admitted into the partnership. Okay, now let's look at our new partnership here and the capital balances and also the capital and the profit loss ratios that would be allocated here. So going back to our example here, the book value of the original partners here was 150,000, investment by the new partner C here for 20,000. So the total capital amount would have been $170,000 for this partnership here, with the new partnership with the admission of the partner C here. But for our recording, we have to it has to be equal to the total implied fair value of the partnership, which we determined to be $100,000. So we have an asset write-down in this example here of $70,000. So let's go down and look at our new partnership here and our capital balances for our new partnership. Now, partner A originally had a capital balance here of $60,000 before the admission of partner C, or the new partner here. So we had this asset write-down here of $35,000 that we calculated based on the 50-50 ratio here, and how we would split the asset write-down that we have to make here between partner A and partner B. So their partnership capital balance here would be reduced by $30,000. So after that, the net balance that partner A would have would be $20,000 or $25,000 in this case here. And then for partner B, they had initial capital balance here of $90,000 before the new partnership was formed, and then they received $35,000 in the asset write-down here. So the total balance here after the asset write-down would be again $55,000 here for partner B here. And then for partner C, they would receive a $20,000 capital balance here, and that was based on the fact here that partner C capital account here should be equal to 20% here of the total capital for the new partnership here. So the total capital was to be $100,000 here. So taking 100,000 times 20% gives us the $20,000 here that partner C would receive here. So after our write-downs here, our total capital balance would be again $100,000, and then the profit and loss ratio here. Partner C would have received, the new partner here, a 20% interest in the profit and losses here, and then partner A and partner B originally had 50% each, so they get the split the difference here. So if partner C gets 20%, then there's 80% remaining here, and then that would be split 50-50, or partner A would get 40% here and partner B would get 40% here. And then again, the capital balances, those are based on what the ending capital, or what the ending capital balance here would be for partner A, partner B, and partner C. Partner C would get 20% here, and then partner B having $55,000 here in their capital balance after the write-down would get 55%, and then partner A here would get 25%, since they would have a $25,000 balance after the write-down here. So again, just to review here, partner C got a 20% interest in the capital and also a 20% interest in the profit ratio here. And then our original our total capital prior to our write-down here was $170,000, but when we write it down here, we have to write it down here to $100,000 using this Goodwill method here. So we have that down here at $100,000. So that's how we allocate our capital, and then our profit losses and our capital ratios here for this new partnership.